Good morning, everybody. Welcome back to Hurdle Rate. We're going to build a DCF model for Starbucks today. The stock price, as you can see on the graph here, has taken a bit of a beating recently from highs of about 125, 120, and it's now trading at about $78. So let's see if this could be a viable opportunity for the company. So yeah, let's get cracking. Go onto the SEC website and pull up the latest 10Q and the most recent 10K, and go on to page 50 for the 10K, and we have our income statement there. So let's get cracking. First thing first, as always, page layout. Let's remove those grid lines. Go view, freeze your first column, insert another, make the A bit smaller, and make your B a bit larger. I'll zoom in a bit as well. For now, that's good. And in A1, put SBUX. That's the Starbucks ticker. Go stocks, and it will find it for us. There we go. Let's start building. Ticker is A1 dot. No. Ticker. So you go A1 dot, open the parentheses, ticker symbol. The date today is the 13th of the 10th, 2025. We want current, implied. Then we want to see if there's any up or downside. And we do the same. I can't just copy the format because it will then copy the ticker, which I don't want it to do. I should have done it. I should have done it first. I should have done the formatting first. What do I want to do? I want to fill it. There we go. But we can copy this one over here. Perfect. The current price, you just go A1. Sorry, equals A1. These two we can leave. Okay, so let's start building out our assumptions. We go revenue segment, and as we can see, there's three here: the company operated stores, the franchise stores, and then other. So company operated stores, licensed stores, other. Then down here, we're doing the free cash flow to the firm. So we'll use EBIT when we need the WACC and the TGV. Copy these two again. We need this. We put switches here. Air, base, bull. Just copy these across. There we go. Now let's get onto the revenue build. I mean, Starbucks should be a generally, I know it's having its troubles sort of at the moment, but it should be a fairly, it's a fairly mature company, and it should have predictable revenues. Equals B10, company operated stores, we want the percentage growth. Just indent these ones. There we go. We're going to start in 2022. So just go equal +1, pull it all the way across. What do we need? 22, 22, 1, 2, 3. We don't need 31 yet. So let's start. We'll just do a quick bit of formatting on the number. Go number, 0 decimal places. Use the thousand separator. Use negative numbers in brackets. Okay, 26576.1, 29462.3, 29765.9, and percentage growth we just do as like that. Now let's copy this. We're going to need 3 of the, well, 2 more. That's equal B11 equals B12. Yeah, okay, looks good. Yeah, just copy the formatting down. So license stores 3655.5, 4512.7, 4505.1. So last year wasn't great. It had this great growth in 2023 in terms in revenue growth, and then that was, yeah, nothing happened in the following year. Other 2018.7. Okay, and let's just we'll start running our total now. Okay, looks good. Let's pull up this is for the first 3 quarters of the year. They'll actually be releasing their financial results soon. It will be next month. So yeah, we'll forecast them and then we'll follow up with it later. Okay, so for company operated stores, if the total revenue was 29766 and at the same time last year they'd done 22323, 22323.8. Let's just see what we need to multiply the 3 quarters by to get a, so 1.33. Okay, yeah, so it's fairly consistent. 22882.9 multiplied by 1.3333. Okay, so slightly better than last year, but I mean, you'd want this growth rate to be closer to this than this, but it is in the middle of a turnaround, and that will take several quarters, maybe even a couple of years to show through. So equals 4505 divided by 3375.7. Okay, again, it's 3257.3 multiplied by point. I guess because it's such repeat purchases, it's very predictable. It's not like one quarter is going to be significantly more than another. I mean, people's routines, I guess, stay the same in all seasons. Three, 5, 8, 1, 4. Okay, yeah, that looks good. Now, let's start building out our forecasts. So if we take an average of the last 3 years, 6%, and I mean, it's not, okay, yeah, but let's say long term, this will settle at 5%. Well, or in 2030, it will be a 5% growth rate. There's a bit of a turnaround. They're getting things back together. I mean, next year, I don't think they're going to be doing 6% revenue growth, though. So I think, okay, average of the last 2 years, I think is a bit fairer. But we're going to expect that to rise up each year. So the way we do this, we go equals. To work out what these next 3 are, we go equals. We take the previous cell, minus, open brackets, the previous cell again, minus the final cell, close brackets, divided by 2030 minus 2026. Now, we're going to copy and paste this again and again. So we need to make sure that it's dynamic and it selects the appropriate rows and the appropriate cells to adjust to for the different categories. So keep this as it is, this one as it is. For this one, we lock in K. So we want to lock the column in. No, yeah, like that. But we leave the row because when it comes down here, we want that to update to whatever it needs to be. We lock, this cell will always be the same. So we lock both in there. And this row will always be the same, but the column will be different. So we lock in the row. And then we do that. And we just need to always does this. Let's go, okay, these need to be percentage. Yeah, but we leave it at 2 decimal place. Okay, so now we have this one. We can just control copy or command copy if you're on a Mac, and then we just paste, and that gives us what we need. And we're going to say the bear case is going to be 95%, and the bull will be 105% of whatever this is. So here we go equals multiplied by E10. Let's lock in E10 and pull that across. Then we do the same with this one, multiplied by I10. Yeah, it's locked in. There we go. And in the switches boxes, just put everything to 2. Leave these 2, but yeah, put all of these to 2. Then we're going to go here, and we're going to be able to play with them. So offset equals offset. The cell that we're in, which is G24, select the switch, but lock it in, because we're just going to pull it across. then a comma, and then a 0. Pull it across. And now to forecast the revenue, we go the previous year multiplied by 1 plus the growth rate, close brackets, and just pull that across. Great. And as you can see, if I change this, remember these numbers here, if I change this to 1, a bear scenario, they go down. That was 31049, it's now 31022. If I put it to a bull case, 31046. So yeah, there we have it. Now, let's do the same with this. Just bring it down, copy it, and we're going to say licensed stores. Let's give this 7% that it goes to. Is that fair to you? I mean, it had a huge jump up in 2023. Sorry, 2023. 23%. Okay, yeah, let's do that. So here we need to put for 11, but because this one is negative, we just have to switch them around. So put this one as I11 and this one as E11, and but for here, we want this one to be E11 and this one to be I11 because, and this is where we put it across, because when it's a negative, the bull and the bear cells, they have to switch round. Okay, we can just copy this down, just update this to C11, pull it across, and again, you can just copy this, pull it across. There we have it. Looks good. For the next one, use this box because I think this one will always be positive. So we don't have to. Yeah, that's good. About E, we just change this to 12. Pull it across. Pull this down, change it to C12, put it across. And lastly, just take that. There we have it. Okay, well, that's our revenue build completed. So at the moment, the company's doing, well, it should do about nearly 37 billion in revenue this year. And we're forecasting that to, I mean, well, pretty much go 1, 2, 3, 4, 5% growth over the next 5 years. And we're factoring in the fact that it's a new CEO, it's Brian Nichols. He did very well at Chipotle, and they're anticipating that that will come to Starbucks as well. So yeah, we'll that's what we're forecasting here, and we'll just have to observe really. The next thing we do is we go into the income statement. We go revenue, and we just put this equal to. Make sure everything is, when you're repeating, make sure it's equal to the line above, so that when we do our simulations, it updates dynamically. Once I can put this down. There we go. EBIT. That's the earnings before interest and tax. We want to know what that is as a percentage of revenue. Start pulling this up a bit. Okay, yeah, let's. Start with, okay, operating income. We might actually, 1 second. Yeah, we'll use this one as, we'll use this. Sometimes it can be a bit, Yeah, we'll do that. Okay. Four six one eight. Sorry, 4617.8. 5870.8. 5408.8. We want to know what that is as a percentage of the revenue. Sorry. $20.25. What are we looking at? Okay. See, this doesn't look great. If it was by this time last year, it was 4101, and now it's only 2.5 billion this year. Okay, and for the next few years, for now, before we're going to set up a simulator later on, but we'll just take an average of the last 3 years, pull that across, and we do. And this is sort of a bit of a placeholder bit at the moment, but we'll come back to it. So the taxes, 948. Okay, so they're paying about 21% tax. I mean, everyone always used to say, oh, Starbucks doesn't pay its taxes, but it looks like they are. Divided by 923. So 619.9 multiplied by 1.30. Let's go with 8. Yeah, okay, that looks good. Okay, yeah, we're happy with that. The next thing is we want the cash flow items. This is your depreciation and amortization. Then we want CAPEX. Then change in net working capital. Okay. We have to go to the cash flow statement. So this is the income statement. This is the balance sheet. Then this one is your cash flow statement. And we want the depreciation and amortization. We want additions to property, plant, and equipment, which is your CAPEX. And then your change in net working capital are these ones here. So let's do that. 1529.4. 1450.3. 1592.4. So as always, and I guess, yeah, that this figure looks fairly normal for depreciation as a percentage of revenue. So CapEx 1841.3. $233.6. No, we want this as a percentage of revenue. We can go so CapEx spend has been quite high these last couple of years in comparison to previous. Okay, so we go for here equals, and it's just the sum of all of these. Remember, the ones in the brackets are negative. So 326.1 minus 641 minus 149.6 plus 345.5 minus 75.8 minus 1625.6 plus 339.6. Okay, well, this is actually quite good for free cash flow, because when this number is negative, basically it means it's as if they're getting paid first before delivering. Yeah, it's having good I guess relationships with their suppliers where they don't have to pay straight away type of thing. Minus 4.1 plus 366.4 plus 52.5 plus 100.1 minus 110.8 minus 14.8 minus 93.7. The same, so we go equals 18.4 plus 42.8 minus 61.9 plus 28 minus 72.2 minus 1294.9 plus 291. Okay, so this tends to be negative. That's actually quite good. Let's see what it is as a percentage of revenue. I think I've made a bit of a mistake here. We need to put a figure in here. We should put the G12. And let's say, I mean, I guess this is kind of like when they're selling in the supermarkets, the pods or the coffee. Let's call that 5%. I think that will be. Yeah. Okay. Well, yeah, that looks good. Now, we need to do 2025. Where is it? There we are. CapEx. Where is it? This one. So divided by 1979.3, 1849.5 multiplied by 1.40327. Now this one, we'll just leave it as it is, because it's hard to forecast this unless you break down each component, which obviously is the right way to do it, but we don't really have time for that. Maybe another day we'll do that. Take your revenue and multiply by percentage of revenue. So D&A will stay fairly consistent. There we go. Okay, now we are looking good. We build the DCF, the DCF section now, and this is where we can simulate the EBIT. So we put this equal to our revenue up here. No. There we go. Okay, now we go EBIT. Equals, but only up to 2025. Pull it across. Now we copy our... Okay, let's... No, copy this one. And we're going to say, let's say it gets back to 15%. What is it? G14. In the bear case, it goes 95% of 15. On the bull, it goes to 105%. So yes. 14. Pull that across. Copy this down. Change it to 14. Pull it across. There we have it. So now we can simulate our EBIT with different, with a bull, base, and bear scenario. We just toggle this to get it to, let's go 1. You do 1 as your bear, your base is 2. See, yeah, it's changed. We can go 3. Yeah, all good. Now, what's the next one? Taxes, percentage of EBIT. So again, copy these up until 2025. We're going to be, yeah, the tax rate will stay is the same, stay similar over the next few years. So average the last 3, pull it across, then take your EBIT here and multiply it by the percentage of EBIT, and this gives us what our tax, well, the forecasted tax. Let's draw a line here. Yeah, that's it. And EBIT, your earnings before interest but after tax. So we go equals your EBIT and subtract your tax. Copy it across. We only need it for the forecasted, we don't need it for anything else. Then now let's just speed through before we start building out the WACC. Okay, now we can get our unlevered free cash flow. So unlevered free cash flow. Bold it. And that is, so we go equals your EBIT plus depreciation and amortization, because it's a non-cash expense, subtract your CAPEX, and minus your change in net working capital. But because this is already a negative number, two negatives make it positive. So this is going to increase our cash flow. And there we have it. Pull that along. And now this is where it gets exciting, because we're going to look for the present value of unlevered free cash flow. But we don't have a discount rate yet. So let's build it. Open a new sheet. Again, always take off your grid lines. Let's, in the top one, go, again, put the ticker in, SBUX. Data. Got it. Got it. Oh, sorry. That was my bad. Okay, so what is the WACC? The WACC, the weighted average cost of capital, is your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So what do we need for this? We need the market cap of the company, the percentage of equity, the cost of equity, and what's in the cost of equity? It's the risk-free rate, it's the beta, it's the equity risk premium. Then we want debt, percentage of debt, cost of debt, tax rate, then we go total, then we go WACC. So yeah, let's bold these. These three, just indent them slightly. Okay, so market cap is easy. We just go equals A1 dot, no, not 52-week high, we want market cap. But remember to divide by 1,000,000, because that's how we've formatted it. So SBUX is currently an $89 billion company. This we can't do just yet. Cost of equity we can't do just yet. The risk-free rate, we know what that is. That is the US 10-year. What is that currently at the moment? 4.059%. 4.059%. These two we're going to build in a second. SBUX is debt. Let's go to the balance sheet. Let's see what's happening there. Current assets. So current liabilities. Okay, so they have 2748.2 and 14570.9. So what was that again? 2748.2 plus 14570.9. Let's just format, make it look good. So total, I mean, when it says total, that's basically your, it's almost your enterprise value. Not quite, because it's not net, It's not add cash, so it's not minus cash add debt, it's just the market cap plus debt. I didn't really need to say that because I wasn't making any, there was not really a point to be made of that. Okay, cool. So we go market cap divided by your total to get your percentage of equity. Percentage of debt is your market cap divided by your total. There we go. Cost of debt, we should have a... Let's see if they tell us. Let's just do the interest payment. Okay, interest expense, 396. So we do, for this, we'll go 396.8 divided by 3 multiplied by 4 to get an annual amount. So 529. So we'll go equals, let's go 529.1 divided by, so it's about 3 and a bit percent. Tax rate we know as being, well, we'll see if they tell us what their effective tax rate is. Okay, the debt. Just tell me the interest rate. Deferred revenue. Okay, we'll just go to taxes. We'll see. Everything's so confusing. Okay. Well, 26.5. Huh? Okay, well, 31.8%. Okay, let's go with. Okay, so now we just need to do our beta and our ERP. Let's start doing that. Yeah, so we want this spreadsheet. So for North America, the risk premium is 4.58%. And this is US and Canada. And StarBucks says North America, yeah, so 4.58%. Then for the rest of the world, come back, where's it gone? What we're going to do, we're just going to delete this one. We get 6.41%. This is rest of the world. So then we do multiplied by the weight. Put it down, we go sum. 4.98%, so F35. Okay, so our cost of equity. So cost of equity equals your risk-free rate plus your beta multiplied by the equity risk premium. So let's do that. Risk-free rate plus your beta multiplied by your equity risk premium. Don't do that. Okay, now we can do the WACC. So percentage of equity let's put these in brackets, multiplied by the cost of equity plus your percentage of debt multiplied by your cost. Sorry, no, I've done that wrong. Plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. There we have it, 7.11%. We put that equal to as so. For the bull case, we say minus 0.5%. Because a lower WACC is generally better. It's G15. There we go. The terminal growth rate will go with 2.5%. And that is after these forecast is done, that's what it's going to keep growing at in perpetuity. And normally I think I don't know what the reasoning is behind it, but everybody seems to put it either as sort of 2.5%. So we won't be any different there. And then we go on this one, so the WACC, instead of using offset, we use choose. So equals choose, we take the switch. Just format it like that. There we go. Now we can find our present value of free cash flow. Just add another row above the DCF segment and put equals 1 plus, so 1 in 2026, then plus 1 in the subsequent years, so until it goes to 5, because we need to use this in the equation. So we go equals unlevered free cash flow divided by 1 plus the WACC, but we lock the WACC in to the power 1. We just pull those across as so. So that's our present value of unlevered free cash flow. Now we want to see what the terminal value is. The terminal value. And this is, we go the last year multiplied by 1 plus the WACC divided by the WACC minus the terminal growth value. So that would be 122 billion is the terminal value of the company. We want the present value of the terminal value. And that is just the terminal value divided by 1 plus the WACC to the power 5. So 86, so about 86, just under 87 billion. Now the enterprise value is we take the present value of the terminal value, goes equals sum, present value of terminal value, and you sum up all of the present value of the free cash flows forecasted, and we get 104 billion. And from here we go add cash minus debt. And we know our debt from our WACC 17.3 billion. Let's pull this over a bit. So okay, we need to come back up to near the top. Where's the balance sheet? Here it is. Yeah, here it is. So we'll put these two as cash. So 4172.6 and the short-term investments at 333 million. From this we can get our equity value. And all that, okay, let's just diluted shares outstanding and implied share price. So equity value is, you take your enterprise value, you add back in your cash, and you subtract your debt. Now your diluted shares outstanding are on your income statement down here. So we're going to go 1135.7. Okay, and an implied share price is easily, you just go 90, you take your equity value divided by your diluted shares outstanding, and you get a share price of 81, which is pretty much where it's trading right now. What's the thing? 108, K108. So yeah, I mean, I guess it's fairly, if we, on the base, yeah, it's fairly appropriately priced according to the DCF. I mean, if we were to go on a bull case, what would happen? If you believe in the turnaround, 109, 110, and it's reached that in the past. One, that's a long way to go down. Yeah. So I mean, yeah, it looks fairly well priced. Cool. Yeah. We'll see how it plays out. We'll see how they do their earnings on the next. I think it's middle of November that they come out. So we'll look at them then. Yeah, let me know what your thoughts are in the comments, and if you haven't already, please do subscribe. Thanks for watching, and we'll see you on the next one.